and welcome. You're watching Closing Trades on ET now. I'm Anisha Jain. With me is Aisha Faridi, and the market is not looking very pretty at the moment because we are below the mark of 17,450 as well. We have broken the low that we had formed yesterday. Slightly off the lowest point of the trading session, but starting the series clearly on a very somber note. So after that 370-point decline in the February series, March has started with a cut of around 70 points. Nifty has been declining for 6 straight sessions, so that weakness is definitely continuing. It's metals which is the key drag on the market today. So you have Hindalco and Nalco which are down 4%, JSW Steel, Jindal Stainless, they're all the counters which are taking a good amount of dropping today. The US futures are also not quite excited. In fact, the last time I checked, the Dow futures were down about 70 points. Remember, there's important data point that the US market is watching out for with respect to the PCE and the consumption data. So that will be important to track. And of course, at the start of the next week, we'll get the GDP data for India. Street is watching out for that. A number of 4.7 to 4.8 is what the street is penciling in. And then it will be the start of the March month. And we'll wait by for the auto sales data as always. But Aisha, for now, it's not a pretty picture at all, whether you look at the large caps or the mid caps.
Oh, yeah, absolutely. And it's been a heavy news flow day, aside of what the index has been doing. Z, for instance, that's been the one case in point. The NCLAT, in a big relief to Z, interim at that, not a final relief, has agreed to hear the appeal against insolvency now on March 29th. They provided that interim relief and they've stayed the NCLT Mumbai order. So Z really has been all over the place. While it started off gap down, from there saw recovery coming in, and now again just languishing mildly soft as we speak right now. Mahindra Lifespace, after that management rejig as well, has been the other one in focus. Arvind Subramaniam resigned as the MD and CEO. I think more than that, it's Anisha on the conference call making all the clarifications, which I guess, focused and highlighted the gravitas of a leadership change at Mahindra Lifespace. So that's another one which is in focus. And Electra Green, fortunately, you do have some of the standout performers in trade, and that is seeing the biggest single day gain since December 2020. It surpassed its 20 DMA as well after aiming at a commercial launch of e-buses in a year's time, along with, of course, a tie-up with Reliance Industries. That stock holding up 18% right now. But Kunal, given the divergence, or rather the gap that you're seeing between the Nifty spot and the futures, the fact that futures still clinging on to 17,500, what do you make of the market?
So the market texture still looks okay to me. We are still holding on to that 17,500 mark broadly on the Nifty, futures. The premium, I think, has reduced from 130 odd points to 92 points. That generally is an indication that possibly the expectation for this series is not as strong in terms of returns as compared to what was maybe 2 or 3 expiries back when the premium started to be at that 120-30 points mark. Net, I think we are still getting into a zone where stocks as well as sectors, or rather risk, is getting adjusted from many sectors. Like the high beta names like metals are seeing a correction. The moderate beta ones, the likes of IT, for example, is showing slight bit of resilience, not too much of a comeback. But then I think these stocks have stopped falling as such. So I think it's more to do with the adjustment which the markets are going through right now, and that's why you're seeing a very placid kind of an action from the indices, not too much of a swing on an intraday basis. The initial half an hour, 1 hour, we saw some good uptick coming by on the indices, but that got sold into because of the adjustment of risk from many portfolios. So I believe that that's how the market texture is likely going to be for the next couple of days.
Okay, so the market texture is going to be the same for the next couple of trading sessions as well. Naresh, what's your reading of how the markets are performing at the moment? It's deep red across the board. The Bank Nifty too, which was showing signs of outperformance, is now down about 100 points.
Session wherein the Nifty has drifted lower on a open to close basis. But what we see is in this correction, we are not seeing a sharper dip across the broader markets. The breadth is not very bad. There are still a few stocks doing well. Say even today, like oil and gas, which I continue to like, is doing well even on a day when the markets are down 50-70 points. So there are some spots coming up which indicates that we may not get into a sharp correction. And this zone is a buy zone, like I've been saying, 17,500 plus minus 50 points is the zone to accumulate. The recent low at 17,350, 300 should hold on. And eventually we could go towards 17,900 to 18,100. That's the view. It could be a slow and steady move. There can be much more opportunities on the broader market side as well as stock specific. Say if we look at the Bank Nifty is back close to that 39,500, 800 mark where it was on the budget day. Stock like HDFC Bank has not corrected much, but is coming into a support zone. SBI, ICICI, all have corrected quite a bit from the highs. So overall, the risk reward is towards a bounce back from here on. So one should be looking at bounce back. Leadership is in public sector enterprises stocks, oil and gas, and power. So this is the sectors I'll watch out for.
Absolutely. I'll also watch out for some of these price volume action buzzers as well, since you talked about the public sector entities, metals and gas doing well. Hindalco, for instance, actually is down today in the trading session, a breakdown from 13 session consolidation. It slipped below the 200-day moving average and the biggest single day decline that we have seen on the counter in over 2 months. So that's the kind of weakness we are witnessing on Hindalco. GAIL, however, has formed that golden crossover. We have talked a lot about how this is an important technical indicator as well. It's been advancing for third consecutive session and has hit a 8-month high on an intraday basis. And Mahindra CIE, that one has been on a tear today. It's up 12% as we speak. It's seen a breakout from 10-session consolidation, has hit an all-time high on an intraday basis, and the volume too are almost 10x the 10-day moving average. Kunal, your take as far as Mahindra CIE, GAIL, Hindalco is concerned, and specifically Mahindra CIE, a lot of strength on the charts.
Yeah, a lot of strength on the charts, and again a strong volume back move for Mahindra CI from 390 to 430, 435. Stock hitting a multi-month as well as a life high for itself. So all things put together, I think it seems to be a good sign for Mahindra CI. At least so far, it seems that this sudden up move could probably now shift the range higher for the stock from being at a point where the 390 was a base for the stock. I think 420, 430 could now be the new support for the stock, and we may look at a gradual uptick. From the other two names which you mentioned, I think Hindalco is something which is very specific and interesting because yes, the stock is down 5.5%, but I think it's tapped back into a very strong support zone, 400 to 420 odd mark. Indicators are showing signs of divergence. I think rather than looking at a sell over here, I would probably expect that this could be a very good zone to go for a contra buy on Hindalco.
Two separate sets of stocks, Naresh, and A, the weakness on metals led by Hindalco today, and B, the fact that L&T has been a bit of a drag for the last two trading sessions, and I think yesterday as well it was down about what, 2 or 3 odd %?
So one, in terms of metals, it's a difficult trade now that the whole cycle has played out, the bounce has played out. So I would still not be very clear where the trend is out here. So it's an avoid for me, not able to make a clear view in this case. L&T is something which I continue to like. This correction, we are going back to the 2050, 2100 support zones, which I expect to hold down. So this is an opportunity closer to 2100 to 2050s where it should be a buy. Even at current levels, it's a buy if one has a medium-term outlook. From a trade perspective, as closer to 2100 with a stop loss at 2050, I expect it to again go back into new all-time highs and be a leader in the capital goods space.
Okay, interesting take there, but also some of these new age tech companies, and we'll get Sharad to join us and talk to us about that because Policy Bazaar is up around 10%. It's now sitting at a level of 580. Let's pull up Paytm as well. 5% higher on that counter, and I think Zomato also was coming up on the radar with some bit of traction coming in. Let's see what that one is up to. Okay, pretty much flat, but at least started off with a bit of a green tinge. If we can go across to Sharad first to try and understand what's happening with the new age tech companies because the path to profitability is getting clearer. Sharad, tell us what exactly is happening and what's working well for all of these counters with the worst of the supply pressure being out of the picture.
Well, yes, a lot of fund interest is also coming in, as you rightly pointed out, but let's look at the numbers, how it is panning out from almost 2022 lows itself. Stocks such as Zomato, Paytm and even PB Fintech, they are up more than 30%. Even a stock like Delivery is also up 8%, barring Nykaa, all of them are in the positive numbers. But then there are important key triggers, of course, coming in. Q3 numbers were largely good, especially for PB Fintech and Paytm as well, and investors have stated that the entire risk reward ratio has turned favorable. However, overall the valuations do still seem a bit stretched, but the thing is there is a focus on cost optimization now, apart from chasing growth, which was earlier the main cause of concern. Apart from this, important thing is there is an important exit of PEs is happening, VCs are also happening, and because of that the post IPO supply numbers, they are also kind of getting normalized going ahead. But also fund buying is coming in and brokerage upgrades also coming in, especially for PB Fintech and Paytm as well. Now let's look at the path to profitability. That's the most important thing which we check for the new age tech companies over here, and Paytm has actually received it 3 quarters ahead of its guidance. While for Zomato, PB Fintech and Delivery, it is still under progress as well. But there's just a caveat that Nykaa is already profitable since listing as well, but there were some profitable, good surprises coming in the third quarter as well. Apart from, of course, Paytm's good news, there was Zomato. For the month of January itself, they have turned EBITDA positive. Now this is without the Blinkit acquisition, and for PB Fintech also, the credit business also turned EBITDA positive at least 1 quarter ahead of their guidance. But a lot of adjustment coming in the Q3 numbers, but the only time will tell when we see the actual PAT numbers coming in the green.
The last
Okay, 17,440. So at least we are maintaining that level and not seeing an aggressive sell-off. So continue to be around that 17,450 mark. Let's pull up the intraday chart of SpiceJet because that one is flying away in trade per se. The company just reported its numbers. The net profit for the quarter has come in at 221 crores, and that compares with 20 crore that the company reported last year. I'm talking about the operating reported performance by the company. The EBITDA is 591 crore against a loss of 387 crore in the quarter gone by on a sequential basis. If you look at the ASKM, that's increased by 5%. The yield also has improved by around 21%. So overall, a good number coming in, and you're seeing the reaction on the stock as well, 9% higher as far as SpiceJet is concerned. Well, let's welcome on board Mr. K.R. Senthilnathan, Director Investments at NAFA Asset Managers as well. Hi, thank you so much for making time and speaking with us. I wanted to begin by discussing the overall market setup with you because, the key triggers for the markets with respect to bulk of the interest rate movement, earnings, etc., budget, they're all behind us now. What could be the triggers going forward for the market because we have been very, very range bound?
First of all, thank you, Anisha, for having me. The triggers could be something like, say, the sentiment itself will be a biggest trigger. So if even the slightest change in the sentiment could give us a positive return, number one. And number two, normally what we would have seen is the pre-election year has been normally muted to slightly negative. And that's what we are watching it this year also. So being a pre-election year, we are getting into a muted mode.
Getting into the neutral mode, but where are you deploying your additional money? Is it like, are you increasing your cash levels at the moment? Is there any sector which is looking attractive at the moment?
Yeah, there are some pockets where there are a lot of opportunities available. Number one being something like, say, a capital goods sector, there are some kind of opportunities. Even in other sectors also, there are some packets of growth available, and that's where we are deploying the cash. So we are not getting into cash mode because always we find opportunities being in a country like India, and that's what we are currently deploying the money.
Okay, also I was going through your some of the top stock holdings that you have, and I see ICICI Bank makes it to the list. Why the preference to ICICI Bank and not, say, an Axis Bank or an HDFC Bank?
So if you look at the ICICI Bank, last 3 years, they have surpassed the growth of HDFC Bank, and then they have been able to gain the market share from HDFC Bank. And still the valuation is, there is a gap between ICICI Bank and HDFC Bank. So in the past, what we have seen is whenever the leader grows more than the market leader, the P gets re-rated, and that's why we are holding ICICI Bank. So yet to capture the potential, and we are optimistic on it.
Sure. Given that, Senthil, you have a niche when it comes to spotting some of the mid-cap hidden gems. Help us understand the rationale behind green panel industries, for instance, because that's not really the most obvious names when one thinks of the housing boom ancillaries.
So the idea behind green panel is something like, say, change in the consumption pattern. So in the past, what we have seen is the wealth creation has happened on the change in the consumption pattern from galvanized iron to CPVC pipes. Similarly, the normal car to SUV. So the same thing we are observing on the green panel, where the consumption is changing from plywood to MDF. So the market share of the low end of the plywood is being captured by the MDF, and that change has been observed on the MDF, and that's why we have picked up green panel. And we are, lot of potential left on this pattern because a lot of consumption is yet to happen, and that's why we are currently holding this company in our portfolio.
Okay, what about the entire consumption theme, and what's the best way to play it as per you? Because the staple names weren't doing too well earlier. At least they've started showing a bit of momentum, and then there are very divergent views coming in as far as urban consumption is concerned. You have the numbers coming from just SpiceJet at the moment, and they tell you there's enough demand even for flights, etc.
True. I mean, like these are all the short-term tactical things which will happen for any consumptions. But what we are trying to see is like the structural change in the consumption pattern. So wherever there is a structural change in the consumption pattern, we will be buyer of that, and that's where the wealth has been created in the past, and we continue to believe on that.
Is it coming in from pure FMCG names? Are you looking at, let's say, QSR? In terms of consumption itself, which basket are you looking at? Because largely when I look at your portfolio, it seems to be a lot more B2B or industrial tilted.
So we do have some kind of consumption, something like, say, we have a Mrs. Vector Foods that is under the consumption. But why we are playing on those things is something like, say, inflation has picked up, and the trade will be back to normal, and that's when these guys will have the pricing power, and hence the margin will go back to the higher levels or go back to normal levels, and that's what the primary play on the consumption stocks which we hold currently.
I see in your books the sector allocation is largest when it comes to chemicals, Senthil. Highlight some of the names that you believe are still good buys.
So one of the stocks which has been classified as chemicals as per the sectoral is Linde India. Linde India is primarily into, air separation units. They are the leader in oxygen and hydrogen air separation units. And that features among our portfolio. And that is why you can see our chemicals weight is on the higher side. And apart from that, there is another stock called ultramarine pigments, which are basically into pigments, and they are very trading cheap, and then their cash flow is huge. So that's why we are holding those companies in our portfolio.
Sure, point taken. APL Apollo Tubes is also an interesting one. Would you want to talk to us about the rationale on this?
Simple rationale being they will be able to gain the market share, and today they are at 50% plus market share in the structural tubes. And it's a low margin business, something like, say, 3 to 4%, because being a converter, but they are able to gain the market share, and they are doing it without doing any mistakes. And that's where the wealth has been created as well.
Right. I also see allocation in excess of 5% when it comes to auto angs, plastic products as well in your books. Stocks that you're betting on here?
So auto angs, broadly something like, say, we hold something like, say, tires companies, and plastic products, it's mainly because of Astral Poly. So where they are already exhibited their strength in converting the galvanized iron to CPVC, and now they have entered into other segments like adhesives and faucets, etc. So those will features under the plastic products. So this is the broad category we have.
Senthil, we'll let you go on that note. Thank you so much for joining us today.
Thank you, Anisha, and thank you, Aisha, for having me. Thank you.
Well, the war in Ukraine, that it's now officially entered second year with no end in sight. The cost of the war, remember, has been devastating, both in terms of lives lost as well as monetary too. But how did it impact global economy? Harsh breaks it down for us. Harsh?
Well, yes, other than the impact on lives and livelihoods, let's talk about the global economy and the impact on that. We'll start off with commodities. You can see that commodities are actually off some of those highs that it had clocked in 2022. So when I'm looking at the 1 year chart, actually commodities are priced lower than where the price of most commodities were a year ago. You can see iron ore though standing out. So other than that, we're looking at cuts across the board over the last year or so. When we switch over to agri commodities as well, you're seeing largely lower numbers even in terms of the agri commodities. And some of these commodities had seen, especially wheat, had seen a sharp run-up post the war in April and May. We had seen a sharp run-up in terms of the prices of wheat. But we'll switch over. Another key part of the war, or what it led to, was currencies. The currencies were really beaten and the US dollar had strengthened. In fact, US dollar went all the way to 115 before coming off. Currently around 8% from where it was a year ago. So that's one thing as a safe haven that the dollar index has done well over the last year or so. And of course, the consequence of both the currencies declining as well as commodities going up rather was that inflation went up through the year, but it stayed elevated despite commodities coming off. So that's one important observation that you have here. So you have India and US both inflation still above the tolerance band of both the central banks, and you're looking at UK and Europe as well. Inflation continues to remain quite elevated, still in double digits where UK is concerned. So that will continue to be a problem, and therefore central banks as a consequence have hiked rates. So you've seen the rate hiking cycle far more sharper in the US than in India, but largely across the globe we've seen central bank hike rates, and a consequence of the rate hiking cycle has been on markets and on the bond markets especially. So we're looking at the bond yield trajectory, which has gone sharply higher. In fact, if I zoom out a little bit from here as well, 2021 bond yields, Indian bond yields were at 6 odd percent, 6.2, 6.3%. It's at 7.4% currently, and US was below 1.5% in fact, and currently at nearly 4%. And that will of course impact markets, but that's what you would feel, and that's not really happened. You're looking at markets which are largely in the green. Of course, tech stocks, the tech basket is a bit beaten in comparison to the others, but you're looking at the Dow absolutely flat. The Russian index obviously 10% down, but other than that, you're looking at global indices largely in the green.
Hey Harsh, thank you so much for joining us. So that's been the 1 year as far as the market is concerned, and how it's impacted all across the board, not only what's happening in the equity markets, so how has it impacted the currencies, the bank rates, as well as the commodities. But it's time now to get some of the top recommendations from our chartist. Naresh, what's the trade that you're executing at this point of time?
So continuing to accumulate HDFC Bank as a contra trade at 1590 to 1570 zones. So that's a stock where the risk reward is in favor in the large caps.
You?
It's ONGC, which I believe is, I think, as at a very good level in terms of a breakout, 150, 354, where the spot level is 155 in futures currently. And that's a stock which looks extremely attractive on the charts, both on the short term as well as medium term. That's a stock which I'm buying.
Okay, quite a bit of weakness, by the way, on M&M. That stock has slipped currently to the day's lows. Similar is the price action with Havells as well. You can see at the bottom of your screens. 2.5% lower for M&M as we speak right now. Havells is well languishing at 1180. What is the index then doing? 0.5% lower still, 17,528 now for the Nifty futures. So, testing that 17,500 level for futures as well. Quick break, be right back for more. Back with closing trades right here in ET now, down about almost 0.5%, testing that 17,500 print, although at that lower end, getting a little bit choppy, at least for the futures, still sub that mark for the Nifty spot, down by 45 points as we speak right now. Asian Paints, which has been, under pressure the last couple of trading sessions, that's made a bit of a rebound. In fact, that's one of the top movers on the index today. Bajaj Finance holding up 1%. Axis Bank is up 1% right now. There's IndusInd Bank and Reliance, which are marginally in the green, but on the flip side, metals are getting clobbered. Hindalco down nearly 5% today. Tata Steel, JSW all down. Adani Enterprises down another 5% today. M&M down 2.6%. L&T futures as well lower, and so is the case with ITC too. Let me now welcome on board Anshul Sehgal and find out what he's been doing in this current market. Anshul, hi, afternoon. Good to have you on the show. Even breathe 17,500 now, Anshul, on the Nifty futures, or rather on the index. Just wanted to understand what is it that you're doing as a portfolio strategy in the current market.
Afternoon, Aisha. Thanks for having me. It's a market of two halves, basically. If you're a short-term oriented investor, it's going to be quite a perplexing market. You wouldn't know what to do, whether to buy or sell. But if you're a long-term investor, then what works best for you is advice given by Seth Klarman. He says that investing is the intersection of economics and behavior. And if you can manage your behavior in this market, then chances of you succeeding in the long term are going to be high. Why I say that is because, I mean, if you were to just go by numbers, Nifty EPS expectation for the next year is roughly in the range of 1,000 rupees, which means that we are trading at about 17 and a half times earnings, which doesn't look cheap. But then if you go by behavior, you will notice that there is all pervasive negativity in the markets. DIIs are holding high levels of cash, nearly 6%. FIIs and other market participants have gone short on the market, which means that they again have a bearish position. This makes the market light and hence prevents material downsides. As a result, our view would be that this is a period where one should be looking to build portfolios and identify stock opportunities where growth is not stunted, yet valuations are favorable. As simple as that. If you can do that, then chances of you succeeding in the next 6, 12, 24 months are high.
It sounds simpler than done, right? I mean, build portfolios, yes, Anshul, but which are the pockets which you think would be the best bet from a long-term perspective? Which are the top bets?
Financials are very interesting. We believe that after a nearly 9-year period, you're seeing double-digit credit growth in the system. That seems to be spurring activity in the financial space. This party has not yet reached the NBFCs, and our belief is that maybe certain pockets of NBFCs will benefit as a result of this party going ahead. In addition to this, India is going to see a cycle of capital goods uptick, mainly because capacities are going to be built over a period of time on account of PLI, government incentivizing capex, and all that. So capital goods companies are great bets to make over a period of time. Consumer durables, if you look at how China progressed over the last, say, 20 to 30 years, their per capita income went up 36 to 37 times from somewhere close to $300 to $12,000 plus dollars. And in the same time, India's per capita income is only $2,000. US is $62,000, $63,000. Now, as per capita income increases and you have all these government schemes coming into play, consumer durables, washing machines, air conditioners, to some extent fans, etc., all those have a significant upside in terms of demand in the country. Now, these are some pockets. Real estate, defense indigenization is a really long-term theme. We believe these are some pockets that one should look at in this market for sure.
Just hold on to that thought. Anshul wanted to flag out Macrotech Developers or Lodha because that stock is suddenly seeing a sharp cut. Let's pull up that if I have it right on my screen. Yes, a sudden 11% drop coming in there. Kunal, I know that real estate stocks have not been doing well and we've been talking about it, but anything you make out of this sudden slip on Macrotech Developers?
Well, not sure why it's happening, but yes, it's not the first time or all of a sudden that the stock is slipping. The last 1 month, the stock has fallen from 1125 to now 700, 720 levels. So it's almost like a 35% to 40% drop in the stock in the last 1.5 odd month. The stock is already at a major multi-year low. I think if I'm not wrong, 2-year, 3-year low for Lodha as well. So doesn't come as a surprise. Maybe the selling could probably accelerate a bit more further.
And I guess it's sort of a domino effect that you've had from ever since the entire Adani saga began playing out, wherein the highly leveraged sectors are the ones which are getting clobbered, and who better than realty when it comes to debt. Anshul, I'm guessing you're also steering clear of realty?
We are very selective in realty. We are not staying clear, but we are very selective. The point that you made is the nub of investing in real estate, which is that if you buy into leveraged balance sheets, then you're exposing yourselves to any excesses that may be created in the business, which always come back to bite such businesses. So we have investments in real estate, but only in companies which are debt free. and where the franchise is so strong that these companies will gain market share from many of the unorganized players and less organized players. So that's the theme that we are playing in real estate.
Okay, let's also look at some of the other buzzers. Whirlpool is having a good day, so 4% higher on that one. Dixon Tech is also up around 3.5%. So that entire consumer durable theme that even Anshul was talking about seems to be having a bit of a positive day, at least for today. And other names are from the platform companies. So Paytm is up around 3%. You also have Policy Bazaar sitting with a gain of around 10%. So good gains coming in there as well. You know what, Anshul, what's your take regarding IT sector at the moment? Because for the year we have seen good gains already, but is it the time perhaps that one should now, probably look at booking profits in some of these names, or is it a good buying opportunity for the long term?
Generally, the year before elections is a year where IT stocks do well. Um, and this year, we say in the year calendar year 22, you've seen the IT index fall off north of 25%. So valuation excesses which have been built up the year prior to that have been taken out of the system in the last year. So to that extent, valuations look much more reasonable in IT now. And in certain pockets of the small and mid cap space in IT, valuations look actually quite attractive. So just going by past trends and the year before elections being good for IT, it looks like this space may hold up reasonably well. In any case, in a volatile year, IT actually is a hiding place. And to that extent, again, IT may seem like a good place to be in the current year. So absolute money making opportunities also and hiding opportunities may exist in IT.
Right, okay, that's the word coming in on technology. Kunal, you are selectively buying tech, right, or IT names?
Yeah, I think the likes of TCS, Tech Mahindra, they're looking very attractive on the charts. From the mid-cap names, something like First Source Solutions as well looks attractive at this 115-16 mark. I think specifically Tech Mahindra is something which we have an oversized position on. My sense is that the stock is getting up for a bigger breakout, something which happened I think a couple of years back in terms of a classical chart pattern breaking out of a rounding bottom formation on the daily time frame. So would be bullish on the IT pack selectively, and Tech Mahindra is one of the ones which we are particularly bullish on.
Okay, Anshul, is there any way you are playing this entire energy transition theme? Because, I mean, for instance, today Electra Green Tech is, of course, excited with the hydrogen bus being, commissioned, and they're expecting the, commercial launch to happen this year itself. You also have the likes of JSW Energy, which are betting big on the hydrogen space, and of course, then the entire EV, plays are there. How are you looking at this transition? What's the best way to play it?
We are of the belief that any change in technology is something that one needs to actually see playing out before one jumps in. That's largely on account of initial plays actually being not so lucrative in terms of shareholder value creation. It's only when volumes come in, it's then that you actually make more money in this space. And by then, proof of concept has also been delivered. To that extent, the energy transition space, we want to wait and see. We want the dust to settle, and that's when we will enter this space. For now, it is too early to see who's going to be a winner in this space. There are many entrants, yet the proof of concept is not yet fixed. And for us, that is not a space for us to go in and jump and add to our position. So we would wait a little bit before we take positions here.
Suresh, your take on a couple of these buzzers. Want to talk about Sanofi? It's up 4% as a result reaction. HDFC AMC is also seeing volumes which are 5x the usual average, Naresh?
So the longer term charts are weak for both these names. So Sanofi has corrected from 9,000 back in 2021 all the way down to sub 5,500. It's a classical lower top, lower bottom formation. So a mild bounce back, not really something to participate in, still an avoid. Same is the case with HDFC AMC. The stock is now very close to the lows it made in May, June, corrected from 2300 just in December. And overall, the stock used to be 3300 back in 2000, pre-COVID as well as in 2021. So overall, charts for both these names are pretty, say, weak in terms of a trend. So this is not a bounce back you want to participate in, just the stocks to avoid.
But it's been a week per se for the Indian markets. The Nifty is down, what, 3%, though the broader markets have fared a tad bit better. And I say that because they are down just around 1.5%, 2%. But otherwise, it's not a great week that the bulls would want to talk about. Metal index has seen a sharp cut this week of over 6 percentage points, coming in from Nifty Metal. Realty has also seen quite a bit of drubbing, a cut of over 5%. PSU names haven't been doing well, a 5% cut coming in there. And Bank Nifty's underperformance really continues with a 3% cut. Actually, none of the sectors, I believe, have managed to end in the green for the entire week gone by. But specifically, Naresh, from the metals pack, after the huge cut that we have seen in the entire series gone by and the last week, is there any name which becomes, favorable on a risk-reward basis?
So the one stock which I would be watching out for is Jindal Steel, which was the leader in the whole rally. 620 has been a major problem for the stock. 520 to 540 is a very strong support area. So once it gets closer to that, that is the price point where the risk reward becomes interesting, or the next time it can sustain about 620. So in terms of the trend, Jindal Steel is the best one in the whole metal pack, which has outperformed. The stock fell from 570 to 300, made the maximum recovery. So out here, now it's getting into a consolidation. A dip to 520, 540 is what I'll be looking out for.
Right. Sharp surge in Biocon, that's the one which is actually holding up very, very smartly. Also some long build-up in a Whirlpool, in a Gale, GNFC. These are stocks which are holding out quite okay. From some of the larger ones, Biocon, of course, is one like I mentioned. There's also HDFC AMC, which is holding up 2.5% right now. There's Naukri, which is scaling up nicely, AB Capital, India Mart, even Adani Ports, for instance, is one stock which is looking quite okay. There's SBI Cards, Bajaj Finance, Canfin Homes, Oberoi Realty. We've been talking about real estate as a space and how debt clearly is an issue with the overall sector. But then, of course, there are some ones not as debt heavy, be it an Oberoi or a DLF. And Oberoi surely is a gainer today, holding up 1% as we speak right now in trade. But Kunal, good move on a GNFC, Gale, Whirlpool. I don't know if you're tracking these charts.
Yeah, Gale, specifically Gale, ONGC, it's the entire energy basket. In fact, IEX, Tata Power, many of these stocks have seen a step-by-step kind of an up move. So that throws the entire light towards the energy sector back again. That the sector which was beaten down significantly in the last, I think, 2-3 months is seeing a lot of revival, and many of these stocks are now coming out from a huge correction for themselves. Just for example, IEX, the stock which was beaten down significantly from 250 odd levels to at 1 point sub 130 mark, is also making a good comeback. So I believe that it's the entire play which looks very attractive, particularly from the oil and gas names. I think ONGC as well as Gale about this 100 mark, both of them, they look very attractive, and I think these are the stocks which I would probably look out for momentum trades from current levels.
Oh, well, yes, and Naresh too has been quite positive on the entire oil and gas space for a couple of days now. So that one is interesting. Let's pull up the intraday chart of GNFC. I want to flag out of why that stock is reacting positively. Remember, one of the largest producers of the chemicals in the world, BASF, has shut its Europe's largest chemical complex. And BASF is talking about a weak outlook, and they are saying that there would be permanent plant closures in a lot of regions in Europe. A job cut of almost 2,600 coming in there. And there could be a perhaps shift coming into India, and that's the reason we are seeing that reaction coming into GNFC. Remember, that plant alone accounts for almost 10% of global TDI production. So that means that there would be a crunch of the production in the world, and perhaps the demand from GNFC will go up and the prices of the product TDI would go up, and that's the reason GNFC is up around 5%. But let's also get some BTSC ideas out of the way. Kunal, you go first. What's on your BTSC list?
So I'll suggest a couple of buy calls over here. The first one is a buy on Hindalco, more of a contra buy. The stock is down 5%, but I think on the short-term charts, in fact on the hourly time frame charts, it's at a classical RSI divergence. So at 414.15 levels would suggest a buy, targets of 430, stop loss at 400. And the second would be a buy on Paytm. Again, a classical breakout. So the stock moved up from 500 to 730 approximately and retraced back at 61.8% mark, which is a classical retracement for Paytm, just around that 600 levels. And from there, it's bouncing back. So would suggest a buy, 588 as a stop loss, targets at 700.
Okay, using the dips to buy on Hindalco and Paytm, ride the momentum on the upside. Naresh, what about you?
So the first would be a BTST on ONGC, would revise the stop loss to 153, a target price of 158, 160. Momentum is strong, a new swing high if you adjust for the 4 rupee dividend today. Second is a sell on Apollo Tires, which seems to have created a short-term top, a stop loss at 324 and a target price of 310.
Right, okay. Just looking at some of the other movers in trade then, and Hindalco, Adani Enterprises. Adani Enterprises, in fact, alone has seen a 25% fall in just the week gone by. The Nifty Bank as well has cracked pretty hard, about a 2.5% cut coming in for the week as well. Kunal, I think the Nifty Bank would have underperformed the index also, right?
Yeah, I think it's underperformed by a good margin. So I think it's not just about the percentage underperformance, but I think it's the manner in which the banking stocks have been just falling every time there is a mild bounce. So even today, for example, when the index was seeing a bounce for itself, Bank Nifty was one of the first ones to witness a sharp selling, and from there you saw many private sector banks as well as large cap PSU banking stocks, they start to get into a negative territory. So that's the bigger concern for the markets, that Bank Nifty is underperforming quite heavily.
Well, Anshul, you mentioned that you're quite positive on the financial sector. Would you want to flag out some of the names that look interesting?
We've been, since last year, we've been talking of a theme where NPAs are going to contract. You will see, NIMs expanding with rising interest rates. And you will see also, as a result of capital being available on most PSU bank balance sheets, then these PSU banks actually going out and growing. And the environment for corporate lending was only improving. We think that this trend is something that has legs. And so next 2-3 years, this trend should play out, which remains positive for the PSU banking space. Even in some housing finance companies, what has happened is that their liabilities are fixed in nature because their liabilities are NCDs, while their assets, which is the loans that they give out, are variable. And as a result, in a rising interest rate environment, they will see expansion in margins. That really is not built into prices because many of these NBFCs trade at anywhere from 5 to 10 times price to earnings, anywhere from, say, 0.8 times to 1 time price to book. And that makes this space quite attractive in our judgment. So these are some pockets where we think, of course, private sector banks remain lucrative. They've shown quarter on quarter immense strength in terms of their numbers. So we believe that this is a space which is a buy on dips, not a sell on rallies kind of a space.
Well, we'll let you go on that note. Thank you so much for joining us. So still quite positive on the PSU banking names, and private banks as always continue to be lucrative. But quickly, since we are wrapping up the week, let's talk about some cues which you need to have on your radar for the coming week as well. From the macro data perspective, watch out for the GDP data coming from India. We're expecting the number to be 4.7%. Fiscal deficit will be important, and globally, the manufacturing PMI data will come on the first of the next month. So we'll watch out for that. In terms of the earnings next week, you have Reliance Industries in India, which will be reporting numbers, and globally as well. There are a few earnings left, but the biggest thing that I'll watch out for from the global context is that tomorrow there'll be that annual shareholder letter that Warren Buffett will really publish. So Berkshire Hathaway's key takeaways will be really interesting to watch out for. In other corporate action, Five Star Business has a board meeting to consider fundraising. Similar is the case with Kolte Patil Developers as well. And Marico will consider proposal for declaration of interim equity dividend. But of course, on March 1st, we'll also get the auto sales data. Auto stocks haven't been doing much of, at least in this week gone by. So maybe they're waiting by for that Q to happen. And then, of course, there's a large NASSCOM event which is coming up in the week, wherein the entire leadership from the IT and tech sector would be there. So we'll watch out for that event as well. Interesting, takeaways is what we're expecting, given the IT sector is seeing quite a bit of focus, Aisha.
Yeah, it is. That's the one which has been fairly resilient as well in the week gone by. It's closing in just a little bit tempered though in trade today. That said, Divi's, Asian Paints, Adani Ports, Bajaj Finance, Power Grid, Coal India, Axis Bank has been some of the big movers today. GNFC, Gale, Whirlpool, Dixon, Aarti Industries. It's an interesting mix of movers when it came to the the broader end of the market today. While the breadth, of course, continues to languish, you've seen pressure for Hindalco, for Adani Enterprises, Penalco, for NMDC, Jindal Steel, Apollo Tyres, Syngene, Vedanta. Metals were the ones which really weighed heavy on the markets today, as did M&M, which was down about 2.6%. There was Indus Towers as well, which was in the red. Cummins, Havells, HPCL, there was Tata Motors, Trent, L&T, ITC. These are all names which have closed in the red for themselves. In fact, it was no different for even a PFC today, or for that matter, even an Abbott India, which closed in lower by about 1.5%. And these are some names which have been seeing some short build up. There's been Rain, Ipca Laboratories, Bosch, Cummins. These have all seen some short build up in today's trading session. That said, some covering as well for an Aarti Industries, for an Asian Paints. Ambuja managed to hold out good, even though it had a choppy session today, but managed to close in the green, nearly touching that 3% gain mark. But 17,568 on day one of the new series managed to defend 17,005K at least on the futures. The spot, of course, gave up at that mark. But wind it up right here, this edition of Closing Trades. We will see you with all the market action on Monday morning.